Welcome back to the Investment Diary, your go-to channel for in-depth analysis of the companies shaping our financial future. Today, we're not just scratching the surface, we're diving deep into Alphabet's Q2 2025 earnings. This wasn't just another quarter, it was a standout performance, largely driven by their relentless pursuit of AI innovation and explosive cloud growth. We're going to unpack the raw numbers, dissect their segment performance, scrutinize their strategic investments, and most importantly, explore what all of this truly means for you, the investor. Stick around, because the insights we're about to share could redefine your perspective on this tech giant. Before we jump into the earnings, let's get a quick snapshot of where Alphabet, or GOOGL, stands in the market right now. Its current price sits at $190 US. We saw a slight dip from its previous close. The trading day started at $191 USD, and so far, we've seen a robust intraday volume of over 58 million shares. All right, let's talk about the big picture, from Alphabet's Q to earnings, which were just released yesterday on July 23, 2025. The headlines are screaming growth, and for good reason. Alphabet just reported a staggering $96.43 billion in revenue, marking a phenomenal 14% year-over-year growth. This wasn't just growth for growth's sake. They handily beat analyst estimates that hovered around $94 billion, showcasing their robust market position. And the profitability, even more impressive. Net income soared to $28.20 billion, an impressive 19% increase year. For investors, the earnings per share, or EPS, came in at $2.31, a solid 22% jump year-over-year, comfortably exceeding consensus estimates, which were in the $2.18 to $2.20 range. So far, the numbers paint a picture of undeniable strength. Now, let's break down where this incredible performance is coming from, segment by segment. First up, Google Services. This is the bread and butter, encompassing everything from their dominant search business to YouTube ads, and even their growing subscriptions and hardware divisions. This segment collectively generated $82.5 billion, showcasing a healthy 12% growth. Diving deeper, search and other alone pulled in $54.19 billion, demonstrating its enduring power. YouTube ads, a key growth engine, expanded by 13% to reach $9.80 billion, and their subscriptions, platforms, and devices segment, which includes everything from Pixel phones to YouTube Premium, saw a significant 20% jump to $11.20 billion. This diversified revenue stream within Google Services provides a strong, stable foundation for the entire company. But the real star of the show this quarter, arguably, was Google Cloud. This segment's revenue absolutely surged, growing an impressive 32% year-over-year to $13.62 billion. More importantly, its profitability is finally matching its growth. Operating income in Google Cloud nearly doubled to $2.83 billion, pushing its operating margin to approximately 20.7%. This is a critical milestone, demonstrating that Google Cloud is not just gaining market share, but is doing so efficiently and profitably, increasingly narrowing the gap with established leaders like AWS and Azure. And the future looks even brighter for cloud. Their backlog, which represents future revenue from signed contracts, grew by approximately 18% quarter-over, reaching a massive $106 billion. This translates to an annual run rate, now exceeding $50 billion. This backlog is a strong indicator of sustained future growth and speaks volumes about the enterprise confidence in Google Cloud's offerings, particularly its AI capabilities. Let's shift gears and look at the financial plumbing of Alphabet, their expenses, and cash flow. The company's overall operating income rose a solid 14% to $31.27 billion, with operating margins holding steady at a robust 32.4%. This consistency in margins, even amidst significant investments, highlights Alphabet's disciplined approach to managing its vast operations. However, the big story this quarter, and perhaps the main reason for the slight stock dip despite stellar earnings, is CapEx, or capital expenditures. Alphabet's CapEx for Q2 alone was a staggering $22.45 billion, representing an astonishing 70% increase year-over-year. This massive outlay brings their projected full-year 2025 CapEx to approximately $85 billion. Where's all this money going? Primarily into servers, accounting for $56.7 billion, and data centers at $28.3 billion. This isn't just spending, it's a strategic, future-proofing investment specifically designed to power their ambitious AI initiatives and expand their global cloud infrastructure. Now, when we look at cash flow, the picture becomes a bit more nuanced. Operating cash flow remains strong at $27.75 billion, a 4% increase. But here's where the CapEx really shows its impact. free cash flow, or FCF, dropped significantly to $5.30 billion, a 61% decline. This is where the market got a little nervous. However, it's crucial to look at the broader picture. Their trailing 12-month FCF still reached a very healthy $66.73 billion. This means that while this quarter saw a temporary dip due to massive investments, the company's long-term cash generation ability remains incredibly strong. Investors need to understand that this dip in FCF is a direct consequence of strategic high-conviction investments that are expected to yield substantial returns in the future. Now, let's talk about the engine driving so much of this growth. Artificial intelligence. CEO Sundar Pichai spent a significant portion of the earnings call underscoring their AI-first strategy, and it's evident across every major product. Gemini, their state-of-the-art AI model, is being integrated at an unprecedented pace across their ecosystem from search to YouTube, workspace, and cloud. This isn't just incremental improvement. It's a foundational shift. Search's AI overviews are no longer a niche feature. They now serve over 2 billion monthly users, fundamentally changing how people interact with information. Furthermore, AI mode available in the US and India has already garnered over 100 million monthly active users, showcasing rapid adoption for a relatively new feature. On YouTube, AI is revolutionizing monetization. YouTube Shorts revenue per watch hour in the US now equals or even exceeds traditional and stream ads. This is a monumental achievement, considering the relative newness of Shorts, monetization, and its importance in competing with platforms like TikTok. New AI-powered features like auto-dubbing and advanced Shorts creation tools are not only boosting creator engagement, but are also directly contributing to this increased ad monetization. In Google Cloud, AI is the difference. The number of big deals involving AI is doubling, and new customer acquisition surged by 28%, largely driven by Gemini adoption. Infrastructure continues to scale globally to meet this soaring demand. Beyond these core areas, Alphabet's Waymo autonomous driving division continues its methodical expansion. They've now surpassed 100 million autonomous miles driven and are launching in new cities, including expanding their services to teenage riders in Phoenix. This demonstrates their long-term commitment to groundbreaking technologies beyond their core advertising business. Despite these undeniably strong results, shares of Alphabet did dip by approximately 2% after earnings. As we discussed, this reaction primarily stems from the significantly raised CapEx outlook. The market, in the short term, often prioritizes immediate free cash flow generation, and such massive investment spending can momentarily spook investors. However, Wall Street analysts remain overwhelmingly optimistic. The consensus maintains an outperform or buy rating on Alphabet, with price targets generally ranging from $200 to $205. This suggests an average upside of about 7% to 8% from current levels. This divergence between immediate market reaction and long-term analyst sentiment underscores the strategic nature of Alphabet's current investments. Analysts are clearly looking past the short-term FCF pressure and focusing on the long-term growth potential. Let's zoom out and consider Alphabet's strategic position. It's abundantly clear that the company's betting aggressively on AI and cloud, and for good reason. Their full-stack AI model, encompassing everything from TPUs and foundational Gemini models to seamless cloud integration and user-facing applications, gives them a formidable competitive edge. They are not just using AI, they are building the infrastructure and models that power the AI revolution. The accelerated profitability of the Google Cloud segment is a critical development. It signals that years of investments are finally paying off, transforming it into a significant, high-margin growth engine that can compete head-to-head with its rivals. Crucially, Alphabet is demonstrating a remarkable ability to balance aggressive innovation with financial discipline. They are maintaining impressive operating margins, even while pouring tens of billions into future-defining technologies. This indicates a mature management team capable of executing a grand vision without losing sight of profitability. Their capital allocation strategy, with a massive $85 billion CapEx commitment, is a loud and clear signal of their unwavering dedication to maintaining leadership in AI and cloud. Tools like VO3, their advanced AI agents, SDK, and the exponential growth of the Gemini app, now exceeding 450 million monthly active users, are concrete examples of this commitment yielding immediate results. Of course, no investment is without its risks, and Alphabet is no exception. As we highlighted, the near-term free cash flow is under pressure due to this monumental CapEx surge. While we believe this is a strategic investment for future returns, investors need to monitor FCF trends closely in the coming quarters to ensure these investments translate into the expected growth. Secondly, regulatory scrutiny over antitrust and ad dominance persists. Alphabet is facing ongoing legal challenges and investigations globally, which could potentially impact their business models. particularly within their core advertising segments. This is a dynamic and evolving landscape that investors must keep a close eye on. Future regulations could shape their operational strategies and potentially impact their financial performance. In conclusion, Alphabet's Q2 2025 was a quarter of significant achievements, particularly in AI and cloud. The numbers speak for themselves. Strong revenue growth, surging profitability in cloud, and impressive user adoption of new AI, while the heavy investment in CapEx will undeniably pressure free cash flow in the short term. For the long-run investor, this represents a bold, strategic move toward securing future growth and leadership in the rapidly evolving AI landscape. It's a classic case of investing for tomorrow's profits today. As investors, we should definitely keep a close eye on Q3 guidance and how Alphabet continues to monetize its AI innovations. Will these massive investments pay off in even greater market share and profitability? Only time will tell, but the foundations look incredibly strong. Thanks for watching the Investment Diary. If you found this deep dive valuable, please hit that like button, subscribe to the channel, and don't forget to ring that notification bell so you never miss our next analysis. Join us next week as we uncover more opportunities in the world of investment.